Simpson Manufacturing has made the connectors holding wood frame homes together since 1956, one of the most quietly dominant businesses in American construction.
Barclay Simpson founded the company in Emeryville in 1956. The first Simpson Strong-Tie connector launched in 1965 and permanently defined the company's trajectory.
The reason this business is special comes down to three words: specified by code. When a code names your product, you stop competing on price and start printing margin.
Simpson spent decades getting connectors into building codes, especially in seismic states. Once in the code, architects spec Simpson by name, and builders do not deviate.
That code entrenchment is why SSD posts a gross margin around 45% while selling what looks like commodity hardware. The moat is invisible to homeowners.
I has run above 20% through multiple housing cycles. Returns that durable do not come from efficiency alone. They require real structural competitive advantage.
North America is the core at about 84% of $2.5 billion in FY 2024 revenue. Structural connectors and fasteners for residential and light commercial construction.
The 2022 Etanco acquisition for roughly $690 million added a European platform. Europe is now about 13% of revenue and the primary international growth runway.
Etanco brought scale in France and Southern Europe, but integration is still maturing. European margins trail North America, making execution on the deal the key 2025 variable.
Housing start sensitivity is real, and investors debate it every cycle. When construction softens, Simpson feels it, but repair and remodel provides a meaningful revenue floor.
Michael Olosky became CEO in 2022 after Karen Colonius retired. He came up through Simpson operations and has maintained the capital discipline the company is known for.
The transition was smooth with Etanco already in motion. Early Olosky results show continuity with the operational rigor and conservative balance sheet of prior leadership.
SSD has grown earnings per share consistently through construction cycles. The compound growth reflects operating leverage. As revenue scales over the fixed cost base of code compliance expertise and testing infrastructure, margins expand. EBITDA margins have expanded from the mid-20s to above 30% over the decade.
That return came from consistent ROIC above cost of capital, not financial engineering. No excessive leverage, no transformational deal rescuing a declining core business.
SSD operates with strong pricing power because its products must meet specific seismic and load specifications. Substitution risk is low. An engineer designing to IBC code cannot swap in a cheaper fastener without requalification. That specificity drives the structural margin premium.
Peer comparisons are tricky. No competitor holds the same code specification moat. BLDR and Trex serve adjacent markets, but the business models are fundamentally different.
The dividend has grown for 10 consecutive years, with a current annual payout of $1.28. Yield near 0.7% makes this a growth signal, not an income story.
Products reach customers in all 50 states and more than 40 countries. North America is mature. International is the incremental growth story if Etanco delivers on margin.
The active SKU count exceeds 100,000 items. That breadth makes Simpson a one-stop hardware supplier and gives distributors reason to keep the brand prominently placed.
ICC-ES certification reports take years to produce and form the basis for code acceptance. A competitor cannot copy the product. They must replicate years of testing data.
The EBITDA margin near 26% reflects that structural advantage. Most diversified industrials run 15 to 20%. Simpson's profile is closer to a specialty compounder.
The primary risk is a prolonged housing downturn. If starts stay suppressed for multiple years, revenue growth stalls and the repair-remodel buffer gets tested more severely.
A secondary risk is Etanco under-delivering on margin targets. At $690 million, any goodwill impairment would be visible and challenge the international growth narrative fast.
Asia-Pacific and Latin America remain largely underpenetrated. If the spec-in model travels internationally, the addressable market expands well beyond today's footprint.
The balance sheet has historically been conservative. Etanco added debt, but free cash flow is strong enough to reduce leverage without constraining dividends or reinvestment.
The long-term thesis is moat durability, Etanco integration payoff, and whether management can sustain ROI above cost of capital as the business grows more international.
That's the Simpson story. The connector behind every wood frame home, specified by code, invisible to homeowners, irreplaceable to builders.
On the bridge, we dig into the Etanco integration and whether the Europe expansion changes the margin and growth profile meaningfully.
Simpson Manufacturing just delivered its largest earnings beat percentage in 4 years. Q1 2026 EPS of $2.13 against a 182 consensus estimate. Revenue of $588 million against $550 million expected.
That's a 31-cent EPS beat, 17% above estimate in Q1, which is seasonally the weakest quarter for residential construction. The stock moved 3% after hours, and that reaction was measured relative to what the numbers actually show.
Full metric strip, EPS actual 213, estimate 182, beat 17%. Revenue actual $588 million, estimate $550 million, beat 6.9%. Year-over-year revenue up 9.1%, year-over-year EPS up 15.1% from Q1 2025's 185.
That year-over-year step-up tells the story. Q1 2025 was 185 per share. Q1 2026 prints 213, 15% improvement with the identical seasonal headwind, single-family construction still running below peak. The business accelerated through the cycle, not with it.
And the company posting that acceleration traces its roots to 1956, when Barclay Simpson founded the company in Richmond, California, making structural steel connectors for residential buildings. The founding insight was simple but durable. Engineered wood frame connections prevent structural failure in high winds and seismic events. That insight became a business. That business became a brand.
The Simpson Strong-Tie brand today is what engineers specify by name when they write a structural drawing, not a connector, a strong-tie connector. When a code document requires your product by brand, you have pricing power that generic industrial suppliers spend decades trying to build. Simpson built it in 66 years of code work.
First development. Residential construction demand showed measurable improvement. Single-family housing starts stabilized in the 1.2 to 1.3 million annualized unit range, as 30-year mortgage rates held near 6.7 to 6.8%. Every new single-family home built in the United States uses an average of $200 to $300 of Simpson Strong-Tie products.
Second, the repair and remodel channel came in strong. R&R is structurally less interest rate sensitive than new construction. Homeowners who can't afford to sell into a thin inventory market are spending on the homes they have instead. Deck permits, room additions, garage conversions, seismic retrofits all pull through Simpson products at retail.
Third, international grew faster than the U.S. core. Europe and Asia-Pacific combined are approaching 25% of revenue, and both regions are in an earlier stage of seismic and wind resilience building code expansion. As European codes tighten, particularly across southern European seismic zones, Simpson captures that tailwind the way it captured U.S. code expansion 30 years ago.
Fourth, gross margin held at 45.9%. That stability in an elevated domestic steel cost environment is the proof point for the pricing power thesis. When the building code specifies your product, you don't negotiate on price the way a commodity supplier does. The margin held because the brand held.
Net of all four, housing inflection, R&R strength, international growth, and margin resilience through steel cost pressure, Q1 2026 validated the full bull case simultaneously. Not one pillar, not two. All four at once in the weakest seasonal quarter of the year. Revenue $588 million, up 9.1% year over year against Q1 2025's $539 million. Full year 2025 was $2.33 billion. This quarter alone is running at an annualized rate of $2.4 billion, a meaningful step above the prior year run rate.
EPS $2.13, up 15.1% from the 185 Q1 2025 print. Trailing four-quarter EPS now rolls to $8.53. At $186.50 per share, That's a trailing PE of 22 times, a premium for an industrial, but one Simpson has sustained through multiple cycles.
The forward EPS projection is where the investment case lives. Full year 2026 consensus was sitting near 9 to 9.50 before today's print. After a Q1 beat of 31 cents, 17% ahead, expect street revisions toward $9.75 to $10. At 186.50, that's a forward PE of roughly 19 to 20 times.
Gross margin 45.9%, operating margin 19.6%, net margin 14.8%. These are not cyclical industrial margins, they're specialty industrial margins, sustained through steel input cost spikes, supply chain disruptions, and construction slowdowns over the past 3 years. The structure is real.
The balance sheet is the headline within the numbers. Net debt of just $103 million against an EBITDA run rate north of $550 million. Net debt to EBITDA is 0.2 times. For a company this profitable and this capital light, that is essentially a net cash position. The leverage is cosmetic.
Free cash flow for full year 2025 was $296 million on operating cash flow of $457 million. Capital expenditure was $161 million, 7% of revenue. On a $7.7 billion market cap, the FCF yield is 3.8% and growing, without a major capex cycle constraining it.
Pillar 1. Code-embedded demand. Simpson Strong-Tie connectors are specified by brand name in building codes across all 50 states and multiple international jurisdictions. A contractor cannot substitute a generic connector when the structural engineer's drawing says Strong-Tie. That is regulatory capture achieved through 7 decades of technical credibility, not lobbying.
Pillar 2. Housing undersupply, secular tailwind. The United States is roughly 4 to 6 million homes short of demand at current household formation rates. That shortage doesn't resolve in 1 year or 2. Every new home built requires Simpson products. The runway is multi-year regardless of quarter-to-quarter interest rate volatility.
Pillar 3. International optionality. Europe is in an earlier stage of seismic and wind resilience code adoption than the U.S. was in the 1990s. As Southern European building codes tighten following recent seismic events, Simpson's European business gets the same regulatory tailwind that drove decades of U.S. revenue growth. That playbook is being run in a new geography.
Pillar 4. Balance sheet as a weapon. 0.2 times net debt to EBITDA gives management complete flexibility. Accelerate buybacks, make a strategic acquisition, raise the dividend, or simply accumulate cash while waiting for the housing cycle to move. The over-leveraged competitors don't have this optionality. They're managing debt service, not capital allocation strategy.
Pillar 5. Margin structure durability. 46% gross margins have been consistent through steel price spikes, supply disruptions, and construction slowdowns over the past 3 years. When your product is code specified, you set the price. The 46% isn't a lucky quarter. It's the normalized output of a product with regulated demand.
Risk 1. Interest rate sensitivity on housing starts. If the Federal Reserve holds the federal funds rate above 5% into late 2026 or signals additional hikes, single-family starts could stall below 1.2 million units annually. At that level, Simpson's U.S. core revenue flattens or declines. The housing call is a real macroeconomic risk.
Risk 2. Steel input cost inflation. Simpson's primary raw material is steel wire rod and galvanized steel. A sustained move higher in domestic steel prices, which are already elevated from Section 232 tariff effects, compresses gross margin even when pricing power is strong. Management has navigated this well, but it is a real cost structure exposure.
Risk 3. Revenue growth rate justifying the premium. At 22 times trailing earnings, investors are paying a specialty industrial multiple for a company that grew revenue 4% in 2024 and roughly 4% in 2023. If 2026 doesn't deliver the reacceleration that Q1 suggests is coming, the multiple compresses materially.
Risk 4. Single category concentration. Simpson has diversified into concrete anchors, chemical fasteners, and international markets, but structural connectors for wood frame residential construction are still the core of the business. Any meaningful shift in construction methodology away from wood frame residential, cross-laminated timber, modular, steel frame, is a structural headwind over a longer time horizon.
Risk 5. Acquisition execution. With a pristine balance sheet under pressure to deploy capital, management's next major acquisition is a significant risk event. Prior acquisitions have been well executed and margin accretive, but a poorly priced or culturally mismatched deal could dilute the return structure that justifies the premium valuation. Capital discipline has been the norm, but norms break.
Simpson's relevant rivals in the brand-specified building products space are Trex Company at ticker Trex, roughly $91 per share and $6.8 billion market cap. Installed building products at ticker IBP, roughly $190 a share and $4.5 billion market cap. Masco Corporation at ticker MAS, roughly $61 and $17.5 billion market cap.
Simpson at 22 times trailing earnings trades above Masco at 17 times forward and well above IBP at 14 times forward. Trex is the closest analog. Composite decking is also specified by architects and builders, also a brand that professionals develop loyalty to, and Trex trades at 24 to 25 times forward. Both command premiums for the same reason.
The most instructive comparison is Simpson versus Trex. Trex makes composite decking, specified by professionals, premium priced versus alternatives, brand loyalty embedded in the contractor network. But Trex is more discretionary. Simpson is literally required by code. That's why the Simpson multiple is defensible, even though it's below Trex. Code required is more durable than specifier preferred.
Installed building products is the cautionary tale in the peer set. IBP installs insulation, labor-intensive, lower margin, more directly correlated to housing starts without the brand moat. At 14 times forward, the market assigns a commodity-adjacent multiple to a commodity-adjacent business model. That's the alternative outcome if Simpson ever loses its code-specified edge.
Masco is the largest peer and the most diversified: plumbing products, windows, cabinets, coatings, and construction products. The diversification smooths cycles but also dilutes the concentrated pricing power that produces Simpson's 46% gross margin. Masco at 17 times forward is a fair multiple for what it is. Simpson is a different kind of business.
The options market implied a move of roughly 4% into the Q1 print, based on the at-the-money straddle pricing in the week before earnings. The actual after-hours move came in at 2.8 to 3%, slightly below the implied range. Option sellers on both the call and put side captured modest premium from the vol crush.
Put-call ratio in the 7 days before earnings was 0.82, modestly elevated toward puts. That reflects how institutional managers hedge construction and housing exposure broadly. When they reduce exposure to the housing cycle in a macro hedge, mid-cap construction suppliers like Simpson get caught in the flow, even when company fundamentals are strong.
Insider activity in the 90 days before the print showed no significant open market purchases or discretionary sells. Routine RSU vesting transactions from the management team are the only SEC filings. That's a neutral read. No insider was loading up ahead of what turned out to be a significant beat, but no one was reducing exposure either.
CFO Brian Magstadt filed a Rule 10b5-1 plan sale of approximately 500 shares consistent with a pre-programmed schedule. That filing is meaningless for directional signaling. No director made an open market purchase in the trailing 3 months. Net insider picture, neutral, with no red flags and no confirming bullish signal from the open market side.
The bull case got direct Q1 confirmation on the two metrics that matter most for the near-term investment thesis. Volume, revenue 9% above year ago, confirmed demand is inflecting. Margin, 46% gross through elevated steel costs, confirmed pricing power is intact. Both simultaneously is not a lucky quarter.
The bear case's strongest argument remains the growth rate question. 213 times 4 quarters implies roughly $8.50 in EPS, in line with the trailing 4-quarter number. The consensus at $9.75 requires Q2 through Q4 to be materially stronger. Management would need to accelerate to the typically stronger summer construction season. That's a real assumption embedded in the bull price target.
But the construction seasonality point actually de-risks the annual number, rather than creating front-loading concern. Q2 and Q3 are structurally the strongest quarters, peak construction season. Q1 coming in at 213 means the seasonal tailwind of Q2 and Q3 is incremental. The beat doesn't borrow from future quarters the way a pull forward would.
The asymmetry question reduces to housing starts. If single-family starts clear 1.4 million units annualized, the pre-tariff consensus for 2026, then $10 in EPS is conservative and the stock is cheap at 20 times. If starts fall below 1.2 million from rate shock, the 850 bear case compresses the multiple. The housing call is the underwriting decision.
Coverage is thin for a $7.7 billion company. 6 analysts total, 3 at buy and 3 at hold, 0 at sell. Baird has maintained outperform since 2020 and reiterated after the Q1 print. D.A. Davidson remains at neutral, which has been its consistent stance since 2022. No upgrades on the quarter, yet.
The price target consensus is $205.25 against today's close of $186.50. That's 10% implied upside set before the beat. Baird's target should move to $215 or above post-print. D.A. Davidson targeting 200 is the anchor pulling the consensus below where it should land after a 17% EPS beat.
The coverage gap matters as much as the target. 6 analysts covering a $7.7 billion mid-cap means institutional investors are doing their own work on Simpson. The sell side is not a comprehensive guide here. That creates a systematic underfollowing premium. When coverage expands or an upgrade cycle starts, the re-rating can happen faster than a heavily covered large cap.
The D.A. Davidson upgrade from neutral to buy is the near-term catalyst to watch. They have not been at buy since 2022. A 17% EPS beat in the weakest seasonal quarter is the kind of print that forces a reassessment of a neutral stance. When that upgrade lands, it has amplified price impact in a 6-analyst coverage universe.
Watch point 1. Monthly housing starts data from the Census Bureau. A sustained print below 1.2 million units annualized flags a construction slowdown that pressures second-half Simpson revenue. A print above 1.4 million confirms the reacceleration thesis. This is the single most important external data point for the investment case.
Watch point 2. Steel input cost, specifically hot-rolled coil and wire rod pricing via the CRU index. A move in domestic HRC above $950 per ton for more than 4 weeks will test gross margin resilience regardless of pricing power. Watch the input trend weekly, not just the quarterly margin output.
Watch point 3. Q2 revenue guidance from management. If Q2 is guided above $600 million, consistent with seasonal step-up from Q1's $588, the full-year $10 EPS thesis becomes mainstream consensus and the stock re-rates. A Q2 guide below $580 would flag that the Q1 beat was more one-time than structural.
Watch point 4. Capital allocation announcement. With $103 million in net debt, $457 million in annual operating cash flow, and $161 million in capex, management has $600 million or more in deployment capacity this year. A buyback acceleration, special dividend, or acquisition announcement will define the next 12 months of multiple expansion or compression.
My bottom line. Simpson Manufacturing is the best combination of quality, defensibility, and cyclical upside in mid-cap industrials. The code-specified brand moat is real and reinforced every year by code adoption cycles. The 46% gross margin through an elevated steel cost environment proves pricing power that most industrial companies claim but cannot demonstrate.
My bottom line, at 19 to 20 times forward on $9.75 in estimated EPS, Simpson is not cheap. But you're not paying for cheap. You're paying for the dominant brand in a regulatory protected niche, a 70-year technical moat, a near-zero leverage balance sheet, and Q1 results that confirmed every pillar of the bull case at once in the seasonally weakest quarter.
The housing call is the key variable. If the construction cycle inflects in 2026 as single-family starts recover toward 1.4 million units, Simpson is a 15 to 20% total return story over the next 12 months. Price target $215 to $220 plus the 62-cent dividend yield. If housing stalls, the multiple compresses and the stock is flat to down 10.
This content is for informational and educational purposes only and should not be construed as financial advice. All investments carry risk, including loss of principal. Do your own research and consult a licensed advisor.
For full episode notes, chart packs, and our complete coverage universe, visit chargedalpha.com. We publish new episodes every week. Hudson and Lana, signing off.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.